Welcome again, dear students and scholars. In videos 1 and 2, we identified operating segments, applied the reportable segment tests, checked the 75% coverage rule, and handled aggregation judgment. In this final video on ASC 280, we complete the reporting story. Once a segment is reportable, users need disclosures that explain performance, measurement, geography, major customers, and how segment totals connect back to the consolidated financial statements. So, this video moves from identification to communication, which is where the note disclosure becomes useful. Once a segment is reportable, ASC 280 requires a disclosure package that lets users see performance through management's lens. The key item is segment profit or loss using the measure reviewed by the chief operating decision maker. That measure may not be GAAP operating income. Users also need information about significant revenues and expenses, segment assets when regularly provided to the CODM, products and services, and how the segment was identified. The goal is not to create a second income statement. The goal is to explain how management evaluates the business. Measurement basis disclosure is critical because segment amounts often come from internal reports, not from the exact same measurement basis used in consolidated GAAP numbers. A company may use operating income, EBITDA, contribution margin, or another internal metric to assess segment performance. ASC 280 requires enough explanation for users to understand what the segment measure includes, what it excludes, how shared costs or inter-segment transactions are treated, and whether the method changed between periods. Without that measurement explanation, segment numbers can look precise but still be misunderstood. Segment information cannot float separately from the consolidated financial statements. ASC 280 requires reconciliations so users can trace segment totals back to consolidated totals. Think of this as the bridge between management reporting and external reporting. Segment revenues, profit or loss, assets, and other significant items must be reconciled to the corresponding consolidated amounts. Individually significant reconciling items should be described separately because users need to understand what creates the gap between segment totals and the financial statements. Revenue reconciliation is usually the easiest bridge to understand. Reportable segments may include sales to external customers and sales to other segments. But when the company prepares consolidated financial statements, inter-segment sales are eliminated. The reconciliation therefore starts with reportable segment revenue, subtracts inter-segment revenue, adjusts for non-reportable segments or other reconciling items, and arrives at consolidated revenue. This is a simple idea, but it is a powerful control against double counting internal sales. Profit and asset reconciliations follow the same bridge logic, but the reconciling items are often more judgment heavy. For profit, the differences may include inter-segment profit eliminations, unallocated corporate expenses, interest, tax-related items, restructuring charges, or non-reportable segment results. For assets, reconciling items may include corporate cash, deferred tax assets, consolidation eliminations, or assets of smaller segments. The point is that users should not be left guessing why segment totals do not equal consolidated totals. Entity-wide disclosures are a separate layer from reportable segment disclosures. Even if a public entity reports only one reportable segment, ASC 280 still requires certain entity-wide information. These disclosures cover products and services, geographic areas, and major customers. This is important because segment structure may be based on how management reviews the business, but users also need a broader view of revenue mix, geographic exposure, and customer concentration. Entity-wide disclosures fill that gap. Products and services disclosures show what actually drives the business. A company may organize its segments by geography or customer type, but users may still need revenue information by major product or service category. For example, a technology company might report one operating segment, but still have hardware revenue, software subscriptions, and service revenue. This disclosure helps users understand business mix, growth drivers, and dependency on different offerings. If grouping by product or service is impracticable, the company should disclose that fact rather than silently omit the information. Geographic information tells users where revenue is earned and where long lived assets are located. ASC 280 focuses on domestic revenue, foreign revenue, and material country level disclosures when relevant. It also requires long lived asset information by geography, not all assets generally. That distinction matters. Geographic disclosure helps users assess regulatory risk, currency exposure, political risk, concentration, and growth opportunities across regions. A company can look diversified in total but still be exposed to one country or region in a way users should understand. Major customer disclosure is about concentration risk. If revenue from one external customer is 10% or more of total entity revenue, ASC 280 requires disclosure of that fact, the amount of revenue from that customer, and the segment or segments reporting that revenue. The customer's name is not required. The point is not to reveal customer identity. The point is to alert users that a meaningful portion of revenue depends on one customer relationship, which can affect risk assessment. When internal reporting changes, comparative segment information may need to change as well. If management reorganizes the business and the CODM begins reviewing operations differently, the segment structure may change. In that situation, prior period segment information presented for comparison is generally restated when practicable so users can compare performance on the same basis. If restatement is not practicable, the entity must still provide enough disclosure to explain the change and preserve usefulness. Comparability is the objective. The IFRS comparison is useful here because IFRS 8 is broadly comparable to ASC 280. Both use the management approach, both focus on the CODM concept, and both identify operating segments based on internal reporting. That makes IFRS 8 a good comparison point for cross border analysis. SAP is different. Statutory accounting should not be forced into a direct ASC 280 comparison unless the specific statutory reporting context supports it. For this course, the safe memory rule is IFRS 8 broadly comparable, SAP only with careful context. For MCQ 1, focus on reportable segment disclosures. The question asks which item is commonly disclosed for each reportable segment. Think about the management approach. ASC 280 is concerned with the measures the CODM uses to assess performance and allocate resources. So look for the option that relates to segment level performance reporting, not employee details, customer personal details, or tax filings. The correct answer is A, segment profit or loss as measured and reviewed by the CODM, that is central to ASC 280. Option B is wrong because ASC 280 does not require salary details for every employee. Option C is wrong because the standard does not require personal identifying details of customers. Option D is wrong because reportable segments are not separate tax filers merely because they are disclosed as segments. Segment reporting is a financial statement disclosure model, not a tax return system. For MCQ2, identify the three entity-wide disclosure categories. These disclosures apply across the entire entity, even when the entity has only one reportable segment. The categories are products and services, geographic areas, and major customers. This question is testing whether you confuse entity-wide disclosure with legal entity names, executive compensation, or transfer pricing policies. Those may be relevant in other contexts, but they are not the three ASC 280 entity-wide categories. The correct answer is A, products and services, geographic areas, and major customers. That is the entity-wide disclosure framework. Option B is wrong because legal entity names are not the focus. Option C is wrong because executive compensation belongs to other disclosure regimes, not ASC 280 entity-wide disclosure. Option D is wrong because inter-segment transfer pricing may be relevant to measurement or reconciliation, but it is not the entity-wide disclosure package by itself. For MCQ 3, think about why reconciliations exist. Segment information comes from internal management reporting, while consolidated financial statements follow external reporting presentation. Reconciliations connect those two worlds. The best answer should explain that bridge. Avoid answers that say reconciliations eliminate segment disclosures, hide management reporting, or replace consolidated financial statements. Segment disclosure is supplemental. It does not replace the consolidated statements. The correct answer is A. Reconciliations connect segment totals with consolidated financial statements. That is exactly why they are required. Option B is wrong because reconciliations support segment disclosures. They do not eliminate them. Option C is wrong because ASC 280 increases transparency rather than protecting internal data from users. Option D is wrong because consolidated financial statements remain the primary reporting output. Segment information adds detail and the reconciliation anchors that detail. For MCQ 4, the focus is IFRS 8 and SAP. The best answer is that IFRS 8 is broadly comparable to ASC 280 because both use the management approach. SAP should not be treated as automatically identical to ASC 280. It depends on the statutory reporting environment. Also, it would be wrong to say IFRS has no segment reporting standard because IFRS 8 operating segments clearly exists. So choose the answer that is useful, accurate, and not overstated. The correct answer is A. IFRS 8 is broadly comparable to AC 280 because both use the management approach. Option B is wrong because SAP does not automatically mirror AC 280. Option C is wrong because IFRS does address operating segments through IFRS 8. Option D is wrong because SAP comparison should not be forced into every analysis. Use SAP comparison only when the specific statutory context justifies it. For short answer 1, the user of the financial statement should be able to understand how each reportable segment performs, what resources are allocated to it, and how management measures it. A strong answer should mention segment profit or loss, segment assets and other key measures regularly provided to the CODM, and the basis of measurement. The best answers do not simply list items, they explain that segment disclosures help users see the business through the same performance lens management uses internally. For short answer 2, explain why entity-wide disclosures and reconciliations both matter. Entity-wide disclosures show business mix, geographic exposure, and major customer concentration, regardless of how many segments the entity reports. Reconciliations connect segment amounts to consolidated financial statement totals, so users do not treat internal segment data as if it were a separate reporting basis. Together, they improve completeness, comparability, and interpretability. One gives broader business context, the other gives numerical discipline. Let us close ASC 280 with the full memory map. Scope, the topic applies to public entities. Approach, segment reporting follows the management view through the CODM. CODM, focus on function, not title, because the CODM allocates resources and evaluates performance. Tests, use the 10% quantitative thresholds and the 75% coverage test. Disclosures, include segment level and entity wide information, including products, geography, and major customers. Reconcile, bridge segment totals to consolidated totals. Compare, IFRS 8 is broadly comparable, while SAP is only relevant when the statutory context supports it. This completes ASC 280 segment reporting. Please like this video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building structured US GAAP education.